Brought to you by Thomas Allgaier and Frennis. This edition highlights key LinkedIn posts on future mobility and market evolution in weeks 49 and 50. Frennis supports enterprises with market and competitive intelligence decoding disruptive technologies, customer needs, regulatory change, and competitive moves. So product teams and strategy leaders don't just react, but shape the future of mobility.
Welcome to our deep dive. Looking at the mobility discussions over the last couple of weeks, there was a really distinct shift.
Yeah, what did you see?
Well, there was less buzz about, let's say, pure futuristic tech and much more focus on pragmatic progress.
Right.
Specifically how policy, governance, and infrastructure are shaping market viability, like right now.
That's the core finding, isn't it? We saw these major shifts in corporate strategy, some really sharp policy warnings in shared mobility, and a clearer picture emerging of where autonomous systems are actually finding some success. So our mission today is to dig into those most crucial strategic nuggets for anyone navigating this space. And I think we have to start with the necessary cautionary tale from the shared economy.
The state of shared mobility, it provides maybe the clearest lesson on market success or failure. Policy alignment is clearly the biggest lever here.
And the headline was Zipcar, right?
The biggest headline, absolutely. Zipcar's decision to exit the UK market after nearly 2 decades.
20 years, wow. When a pioneer like that pulls out, it just sounds like a fundamental business failure.
It sounds like it, but the conversation suggests the failure isn't with the business model itself, it's really with the regulatory environment.
Okay, so how did that play out?
Well, Sandra Phillips detailed this perfectly. She pointed out that London operates within one of the world's most complex regulatory environments.
Different rules for every borough, I've heard.
Exactly. But the real hammer blow was the decision not to exempt most car club vehicles from the congestion charge.
That feels like a crushing financial decision. If the whole point is to reduce congestion, why would policy actively penalize the shared option?
It's a perfect example of conflicting incentives. Russell King really highlighted this. He said, the core mistake was charging shared vehicles multiple times more than residents for parking.
So you're breaking the unit economics.
You're breaking them entirely. When you force shared vehicles to carry those disproportionately high costs, the financial incentive for the operator and then for the user, it just collapses.
Right.
And that failure means London's shared car rate is going to drop, which really hurts the overall mode shift the city needs.
That policy paralysis is it's really eye-opening. It shows even the best tech can be torpedoed by misaligned rules.
Precisely. And this is why commentators are pushing for systemic change. Simon Swan, for instance, he laid out some potential interventions.
Like what?
Things like treating car share as an essential public service, or even mandating developers include car share spaces in new parking structures. Bake it in from the start.
So while the story in London is grim, we shouldn't think shared mobility is doomed everywhere.
No, not at all. Hashim Al-Fatayerji highlighted a very different growth picture in places like Saudi Arabia. Globally, users are projected to more than double by 2027. So the market is healthy where the policy is supportive.
And it's not just about policy, but also inclusion.
Yes, and that was a critical point. The small co-creation guide was released, shared by Sar Faivez and Sammy Engsthelm.
What's the focus there?
It's a guide to help cities and operators build genuinely inclusive shared mobility. So engaging people with reduced mobility right from the design process. It's about creating a truly usable service.
That holistic approach is key. Okay, so let's move from shared cars struggling with regulations to lighter vehicles. The micromobility sector seems to be having a better time.
It is showing strong momentum, definitely. It's backed by specific targeted investment. Horace Didiu noted that Lu'up, the Japanese operator, raised a significant $28.1 million.
And what's interesting there is their strategy, isn't it?
It is. Their focus is on a universal vehicle concept called Unimo. It's specifically designed to broaden accessibility, which echoes that equity focus we just talked about.
And what unlocks this growth isn't just the vehicle design, it's the physical commitment from cities. Prabin Joel-Jones had some compelling data from London, actually.
Oh, this is a great contrast.
It is. While shared cars struggled, the city's dedicated cycle network grew massively, from 90 kilometers up to 431. The result? Daily bike trips surged by 43%.
That data just reinforces that straightforward idea. Build the dedicated trusted lanes and people will use micromobility.
And the commitments are becoming foundational policy. Timo Muller flagged that the Netherlands is committing a staggering €1 billion to cycling infrastructure by 2030.
$1 billion. That's a clear statement that they see this as a national economic and mobility priority, not just a green initiative.
Exactly, and we're seeing it at the hyperlocal level, too. Emily Shoveler was celebrating the 150th residential bike hangar in Ealing.
And those are so crucial. Those little curbside changes remove the storage barrier that stops so many people in cities from owning a bike.
So you have the infrastructure, but then there's the business model. Mario Presi suggested the bike industry itself needs a massive shift.
Away from just selling bikes.
Right, to operating bike as a service.
And that move is strategic for resilience. This model, monthly leasing, guaranteed buybacks, it could transform their revenue streams.
More predictable income, less unsold inventory.
Exactly. It moves them away from those risky production run and discount cycles. And that focus on resilient operations, it extends to logistics. Hans-Bjørn Wagu noted Voi opened a new central warehouse in Poland.
Which isn't just for storage.
No, it's a sophisticated move to extend vehicle lifetime and drastically improve their maintenance logistics. It shows that even micromobility needs a mature, scalable operational backbone to be truly sustainable.
Okay, let's move up the tech stack. Let's talk about autonomous vehicles.
Right. John Jerica's highlighted that Europe's robotaxi landscape is really heating up. It's becoming a competitive mix of US, China, and local players, all aiming for major 2026 deployments.
We even saw a specific collaboration announced in Oslo.
Yes, between MOIA, Ruder, and Hollow, also starting that same year.
But, that optimism around the tech, we also saw a necessary reality check. Brooke Krieger challenged the whole industry narrative.
Her point was so important. She argued quite clearly that AVs will ultimately fail everywhere that public transit has already failed.
So it's not a tech problem.
It's not. She argues the bottleneck is governance. Things like urban sprawl, revenue models built entirely on private car driving, and just deep political resistance to change.
So you can't just drop AVs into a broken system.
You can't. They won't scale beyond these little pilot zones unless cities fix the foundational issues that have plagued transit for decades.
So the success stories we do see must hinge on governance that enables that deep integration.
Exactly. And Kevin Kargar presented Abu Dhabi as the prime example. They are successfully shifting autonomous taxis, buses, and drones from limited pilots to full public deployment.
How did they manage that?
They built what they call a digital backbone. This means connected intersections, unified control centers, and, maybe most importantly, an integrated regulatory framework. One set of rules.
Which eliminates that regulatory uncertainty we saw cripple Zipcar in London.
Precisely. But even with that robust governance, the operational hurdles are still significant. Nicholas Nuri shared a great little anecdote about two Waymo robotaxis in San Francisco.
They bumped into each other, right?
Yeah, it's a dump. It wasn't a major crash, but it was two vehicles struggling to navigate a twinny double-parked street scenario.
A real-world edge case.
Exactly. And it emphasizes that real-world deployment is messy, it's slow, and it's full of things no simulation can fully capture. It's going to be a long evolution, not a sudden robots in, humans out moment.
Yet the efficiency metrics are starting to look promising. Ryan Green pointed out an intriguing metric from California on Waymo's deadhead miles.
Right, the miles driven without a passenger.
Those are trending down. They dropped from over 51% to around 44%.
That trend is the strategic takeaway. Now, 44% is still high, but the direction is key. It suggests Waymo is mastering fleet dispatch and routing.
Which means lower operational costs and better profitability potential.
And that's compared to the slightly increasing deadhead miles for human rideshare drivers in LA and SF. It shows AVs might just be starting to win the efficiency game.
Okay, let's look now at how corporations themselves are adapting. Michael Miller stressed a key message for stakeholders. Car policy is not mobility policy.
I love that quote. The shift is away from just controlling the physical fleet, which is a perk, and towards managing employee needs for efficient, flexible transport.
And this shift is being driven by the balance sheet, isn't it?
That's the crucial insight, yeah. Max Coley detailed how these decisions are moving from the dealership to the finance office.
So we're talking about CapEx versus OpEx.
We are. Auto subscriptions and long-term rentals let companies move mobility costs off balance. They shift from capital expenditure, or CapEx, where cars lock up capital, to operating expenditure, OpEx, which is a flexible monthly cost.
Which frees up a huge amount of capital.
And gives them far more flexibility. And that need for context-specific flexibility is reinforced by new data out of Belgium.
Right, the new Federal Mobility Survey.
Nicholas Verstraete shared the insights. While 78% of kilometers are still done by car nationally, the regional differences are enormous. Only 43% in Brussels versus 73% in Wallonia.
That just proves that mobility solutions have to be hyperlocal. A one-size-fits-all policy just doesn't work.
It can't. And yet, even when policy tries to be flexible, delays can paralyze the market. Joris Spigt warned that Belgium's mobility sector is being held hostage by fiscal uncertainty due to delays with the mandatory mobility budget.
It's the Zipcar problem all over again. Lack of clear long-term rules means no one wants to invest.
Right. And this demand for clarity feeds directly into urban design. Hassan Sukur emphasized that mobility hubs have to be more than just parking spots.
They need to be human-scale public environments.
Exactly. Integrating multiple modes, providing climate-responsive comfort, and becoming lively community nodes. Gil Cohen pointed to Detroit's new multimodal hub as a catalyst for exactly that kind of growth.
So if we connect the dots across all these sectors, shared, autonomous, corporate, micromobility, what's the common thread?
It all comes back to the foundation. Thomas Broughton used San Francisco's historic tram network to remind us that real mobility scale comes from infrastructure, not software alone.
And he sees that same inflection point now in shared micromobility. He argues that trusted parking infrastructure, like those bike hangars we mentioned, is what unlocks real scale.
You can't run a billion-dollar service on a $50 piece of curb regulation, and we saw major global investments confirming this. Richard Cup sounded the Riyadh Metro.
The world's longest, fully driverless metro network.
Is being positioned as the physical backbone of Saudi Arabia's entire smart city and investment strategy.
And you can complement that massive infrastructure with intelligent systems. Matteo Forte highlighted the surge in demand-responsive mobility, or DRM.
Also known as DRT, Demand Responsive Transit.
So what's new here?
Well, it's the role of AI. AI is enabling real-time decision-making and really complex algorithmic pooling. It moves transit away from fixed schedules to flexible services that can optimize thousands of routes at once.
That's driving the market toward an expected $85 billion valuation this decade.
It is. And even traditional transit is innovating its planning. Niels van Oort shared that TU Delft researchers developed 4 future scenarios for public transport.
How does that help?
It helps policymakers visualize potential paths forward instead of just reacting. The scenarios are based on whether tech acceptance is high or low, and whether change is market-driven or government-driven.
And finally, a great example of reframing existing infrastructure.
A beautiful one. Artur Wolnicke highlighted Europe's night trains, which are being successfully reframed not as old, but as a comfortable, sustainable, scenic alternative to short-haul flights.
This whole deep dive, it really reinforces that technology is the engine, but policy and infrastructure, they're the steering wheel and the chassis.
Absolutely. We saw this constant, painful tension between ambitious tech, like AVs, and the practical policy frameworks needed to support them. Zipcar's exit, Belgium's budget delay.
So you need the big foundational vision, like Riyadh's metro, but you also need that detailed commitment, like the Netherlands' €1 billion cycling investment.
And for you listening, the takeaway is that your strategy has to leverage these insights. You have to shift from just reacting to the market to actively shaping it by engaging with the regulatory environment.
And if we connect all these points, the policy failures, the infrastructure needs, the focus on efficiency, it raises a really important question for you to think about. What happens when market-ready solutions are systematically overlooked by policy?
Michelangelo Ligori pointed out a powerful regulatory blind spot here. Electric microcars, the L70 vehicles.
Okay, so these are ideal for urban sustainability, low resource consumption.
So what's the problem?
They are currently excluded from key EU co-Eurofleet targets and funding mechanisms.
Wait, really? So they don't count?
They don't count, which means manufacturers are strategically incentivized to prioritize selling heavier, less efficient vehicles that do count toward those targets, even though the L70 is a fundamentally better solution for urban travel.
That regulatory gap is actively preventing a more efficient solution from reaching scale.
That's a powerful thought to leave with. The future of mobility hinges not just on what we create, but on which policies we choose to champion and which regulatory blind spots we finally choose to address.
If you enjoyed this deep dive, new editions drop every 2 weeks. Also check out our other deep dives on electrification and battery technology, next-gen vehicle intelligence, and commercial fleet insights. Thank you for joining us, and we hope you walk away better informed. Subscribe to ensure you never miss our next analysis.